Welcome to our discussion on financial statements. This lecture will provide an overview of the financial statements used to report data about businesses to stakeholders. After we record information about individual transactions that we discussed in the last lecture, this data is reported to stakeholders through financial statements. The financial statements provide a standardized means of reporting financial information from businesses that allow stakeholders to compare the performance of one business over several financial periods or from one business to another. The financial statements must be prepared in a specific order, as the information from one is necessary to complete the next financial statement. The order the financial statements must be completed in are first the income statement, then the statement of owner's equity, and then the balance sheet. The income statement concludes with net income, which is needed to complete the statement of owner's equity, which concludes with owner's ending capital balance, which is needed to complete the balance sheet. We will examine each financial statement independently in the order in which they are prepared. Some general information applies to all financial statements. All financial statements have a heading, which includes the name of the company, the name of the financial statement, and the date. The income statement is a summary of the money made, revenues, and the money spent, expenses, to generate that revenue. The general equation is revenues minus expenses equals net income, or a net loss if expenses for some reason should exceed revenues. Income statements list all the revenue accounts for a business first, followed by all the expense accounts for the business. For our purposes initially, we will list the expense accounts from the highest account balance through the lowest account balance, with miscellaneous expenses always being listed last on the income statement. Income statement accounts are also known as temporary accounts, since they start with a zero balance at the beginning of the financial period and grow over time, and then are returned back to zero balances at the end of the financial period in preparation for the next financial period. The date on the income statement is for a period of time and is reflected as either a month or a quarter or a year, depending on the length of time the financial statement is prepared for. We see here the formula to achieve net income. As stated before, revenue minus expenses will give us net income or a net loss, and that is basically what an income statement provides. One of the questions that's asked is, where do we get the information that we need to prepare an income statement? And here we see a familiar slide that we saw in the last lecture, which shows the accounting equation and the different categories of accounts that affect the accounting equation. And in order to prepare the income statement, we use these accounts here, the revenue accounts and the expense accounts. Here's a typical income statement, and we see here that we start with the heading. The name of the company is Golf Heaven Travel. The name of the financial statement is the income statement, and this particular income statement is for a year that has ended on December 31st, 2008. We also see here that this company has earned a total revenue from fees earned of $250,000 and have the following expenses: wages, $65,000, rent expense, $25,000, utilities expense, $18,200, supplies expense, $2,800, and miscellaneous expenses, $1,500. And we see that they are listed, as we stated, in order from the largest expense balance to the smallest, with miscellaneous being listed last. We have a summary of all the expenses totaling $112,500. If we take $250,000 revenues and subtract our total expenses, $112,500, we have a net income for this company for the year of $137,500. Note that for our purposes, totals are expressed in the right-hand column of the income statement. Subtotals are presented in the left-hand column and then totaled out to the right, and that allows us an easy way to access our total revenue and our total expenses to come up with our total net income. The statement of owner's equity cannot be completed until the income statement is done because you need the net income number or net loss number, if it was a loss for the company, in order to complete the statement of owner's equity. The accounts needed to complete the statement of owner's equity include the capital account and the drawing account from the statement of owner's equity section of the accounting equation. The statement of owner's equity summarizes the activity that affects the owner's capital over a period of time being reported on financial statements. The capital account has a beginning balance at the beginning of the period, and if a company is starting out new, this first financial accounting period for the capital account will start with a zero balance, like it did in some examples in our textbook. Otherwise, the beginning capital balance will be the same as the ending capital balance from the previous accounting period. In other words, if we ended December 31st, 2007 with a balance in our owner's capital account of $25,000, the beginning balance January 1st, 2008 in the owner's capital account will be that same $25,000. The statement of owner's equity then summarizes any additions to the capital over the period and any subtractions to that capital account over the period, and concludes with an ending balance in the capital account at the end of the accounting period. There are basically 5 steps that we use to complete the statement of owner's equity. We start with the first step, which is the beginning balance in the capital account as stated like owner's capital January 1st, 2008, or whatever the appropriate date happens to be. The second step is any additions that have been made to the capital account. And here we have 2 possibilities. Either the owner can contribute to the capital account, either initially or additionally later on. The second way we can add to the capital account is through net income that was reported on the income statement. We'll see here when we see a statement of owner's equity where those things appear in the proper format. The third thing that affects the statement of owner's equity are things that are subtracted from the capital account. And again, we have 2 possibilities here. The first and most common is when the owner withdraws money from the business for personal use. This is the balance in the drawing account, as we were shown in the last problem that we demonstrated. When the owner takes money out of the business, it's called a draw. We have a balance in that account, and that balance negatively affects owner's equity and therefore ultimately the owner's capital account. The other way that we can subtract from capital is if the income statement had been concluded as a net loss. In other words, the business lost money over the financial period, then we would subtract that amount in this area in step 3. Step 4 summarizes the increases and decreases down to one number, and we have either a total net increase to capital or a total net decrease to capital, depending on what our increases and decreases were in this particular financial period. But step 4 is to net out the increases and decreases and state whether we had a net increase or net decrease to owner's capital. The last step in preparing a statement of owner's equity is then to come up with the ending balance. And we take the beginning balance number and then we add a net increase to the owner's capital. If for some reason we would have a net decrease to owner's capital, we would be subtracting that number from the beginning number in order to come up with the ending number, which will be stated as owner's capital December 31st, 2008, or whatever the appropriate date is for the end of our financial period. Here we're showing a graphic of the accounts that are used in the statement of owner's equity from our accounting equation. And we see that we have the capital account. We're going to need the beginning balance of that. And we're also going to come up with an ending balance in that through the statement of owner's equity. We need to know the owner's drawing account. But we also affect this capital account through the income statement with these particular accounts, our revenue accounts and our expense accounts. They've already been summarized in the income statement, but these 4 accounts, as we learned in the last lecture, affect owner's equity, 2 of them positively, 2 of them negatively, and we see that through the statement of owner's equity accounts plus the income statement accounts, we're going to come up with our owner's equity at the end of the accounting period. Here's a typical statement of owner's equity. Again, we have a heading. We have the name of the company, the name of the financial statement. This, again, the statement of owner's equity is for a period of time, either a month, a quarter, or a year. This one happens to be for a year, and we have the date that that period has ended, in this case, December 31st, 2008. Here we have step 1, which is beginning capital. Here we have step 2, which is additions to the capital account. In our case, we only have one, net income. The owner did not make any additional contributions, so that line is just left out. Step 3, subtractions from the capital account would be, in our case, only one of the two possibilities, the withdrawals by the owner. And so our increases were $137,500. Our decreases were $40,000. The increases is larger, so we have step 4, a net increase to the owner's equity of $137,500 minus $40,000, or $97,500. Then we go to step 5, which is our ending capital amount, stated here as the name of the owner, the capital, and the date, December 31st, 2008. We took the beginning balance of $115,000. It was an increase, so we're going to add $97,500. Our ending capital amount is $212,500. The balance sheet is the last formal financial statement to be completed. The ending capital number from the statement of owner's equity is needed to complete the owner's equity section of the balance sheet. Balance sheet accounts are known as permanent accounts. Unlike income statement accounts, the balance sheet accounts account balances live on from accounting period to accounting period, where the income statement accounts are zeroed out at the end of the accounting period and start all over for the next accounting period. The balance sheet provides a snapshot in time of the current financial position of the business. It's only a snapshot in time because as transactions occur, the current state is going to change. And so as of right now, the balance sheet accurately reports it, but tomorrow it will be different as transactions occur. Assets are listed from most liquid to least liquid for now. Cash is always the most liquid since liquidity deals with the ability to convert an asset into cash. Traditionally, accounts receivable is listed second on the balance sheet, and from then on it's a judgment call as to which assets are more liquid than the other. As you work the problems in your textbook, you'll get a feel for the order of listing of assets, and as we work problems in future chapters, this will not become an issue for you, as the balance sheet will be broken up into more complex categories, and the accounts listed there will be obvious. The next section of the balance sheet deals with liabilities, and for right now that's a pretty simple one for us. We only have one liability account that we're dealing with in this particular chapter. That's accounts payable. As we add more liability accounts, again, the order in which they're listed will become quite evident. The last section of the balance sheet is the owner's capital account, the ending balance coming from the statement of owner's equity, as we stated above. The balance sheet that we're going to be looking at here in a couple of slides is in the account form, and an account form shows assets listed on the left and liabilities and owner's equity listed on the right, ending with total liabilities and owner's equity, which should add up to be equal to the assets number, just like our accounting equation. There is an alternate form, which is the report form, which there's an example in your book if you want to go look at that, but it lists the assets on top. Then below that we list the liabilities, and yet below that we list the owner's equity section. And again, I prefer the account form because it looks a lot more like the accounting equation. It's also easier to pick out the ending balances for total assets and the ending balance for liabilities plus owner's equity to compare the two to make sure they're in balance. If for some reason those two numbers are not equal, then we've got a problem somewhere and we've got to go back and fix that. Here again we see the slide with the 6 different account categories, and we're showing which of those categories deal with the balance sheet. It's the asset accounts, the liability accounts, and then the one number from the owner's equity, the statement of owner's equity ending capital balance is what we're going to need there. We have an example here of a typical balance sheet. We see once again a heading, the name of the company, the name of the financial statement, which is the balance sheet, and here notice the difference. This is not reported for a period of time. This is as of December 31st, 2008, because January 1st is going to roll around. Somebody's going to send us a check. We're going to write some checks. We're going to buy some things, and all these numbers in assets and liabilities may change overnight. But as of this snapshot in time, here are our numbers. This is the account form, assets listed on the left. We have the heading, assets. Then we have cash, the most liquid, listed first. Accounts receivable, traditionally listed second. And in this case, we only have three assets. Supplies, listed third. We add up those three numbers. We get our total assets here, $225,000 worth. Over here on the right, we have our category for liabilities. As discussed right now, only one liability account, accounts payable. Its balance is $12,500. Again, we can find that number from the problem that we worked earlier under the liabilities section of the accounting equation under the accounts payable. This would have been our ending balance when we worked it out in that particular problem. The third category, the owner's equity section, here's the owner's capital account. This number right here, $212,500, is the number that comes from the statement of owner's equity. And when we add our total liabilities and our total capital number from our owner's equity section, we see that total liabilities and owner's equity is $225,000, which is the same as our assets. They are in balance, thus a balance sheet. And if we look at it, the accounting equation, assets equals liabilities plus owner's equity. This concludes our discussion on financial statements. I look forward to our next meeting.